Sound of Money with Santosh Sirur.
Hello and welcome to another super special episode of the season 3 of my podcast, The Sound of Money. Again, on this episode, I have a wonderful, truly wonderful guest whom I got connected to through a network, and he's so knowledgeable. Not just knowledgeable, he's so experienced and he's so well networked. So many people, institutions, and within minutes he became a very good connect for me. I'm very thrilled and excited to introduce my guest on this podcast, Mr. Joydeep Sen. Hi, Joydeep, and welcome to my podcast, The Sound of Money.
Santosh, thank you so much. And thank you so much for the wonderful introduction. I owe you a coffee for this introduction only.
Absolutely. Definitely. Thank you so much. So Joydeep, well, how do I introduce you? So he wears many hats. And in each hat, he's a magician. That's how he is. So essentially, he's been a banker, essentially into working with BNP Paribas for over 13 years. Having said that, experience in the financial services industry for more than 25 plus years. He's a columnist and has written for some of the top-notch newspapers in India, financial newspapers. He's been on television shows, again, in some top-notch television channels. The good part is he's also written books. I don't know how you find time, Joydeep, for this. And he's written not one or two, but 4 books. Books on fixed income. He's written books on mutual funds. In fact, the book that he wrote on mutual funds is one that has been recommended for MMS course, and that too in a prestigious course like with Mumbai University. He's also written books on management lessons and also on financial planning and wealth management, that again in 2 parts. Apart from that, he trains students, professionals in some top-notch premier institutions of India. And he's also been awarded the 100 most influential BFSI leaders. And I'm absolutely not surprised when I read that, not once, but twice. I think 2019 and then in 2023. Wow, that's amazing. So he's in fact the most admired BFSI professionals, and I can't agree more, because when you meet him, you break ice so very quick with Joydeep that it's easy to kind of, connect with him so very well. So that's Joydeep Sen joining me on a very super special episode of my podcast, The Sound of Money. So Joydeep, where do we begin? Is it your banking experience? Is it about your training experience? There's so much to talk. So I thought, let's not wait a bit more. Let's get on straight into the the discussion. And for our audiences, just to give you a peekaboo onto what comes up in this episode, or maybe the episodes, is Joydeep is going to discuss about investment industry, essentially investments, but various kind of facets that one needs to know when you're investing. As most of us are investors and invest in every product that we know of, but there are certain nuances one needs to be aware of. And I think that's where Joydeep specializes, to kind of caution us, guide us, and maybe even channel our thoughts into. Be it mis-selling, mis-buying, it could be basic investments, it could be, whether I can do my investments myself as DIY, as we say, or do I need a professional investor? Mutual funds or stocks, what's more important? Geopolitical scenario, which is just not out of our control, but we need to be aware of it. There's so many topics that Joydeep can, talk to us. So let's get started with Joydeep. Joydeep, my first question to you is, of course, is the fundamental approach to investing, right? A lot of times in India, and I'm sure globally also, people look at it between friends, between office colleagues, between peers, talk about it within family, friends, Saturday evening, weekend discussions, and think, oh, chalo, it's like that FOMO factor, fear of missing out. But then whether they have that capacity and also the reality of life to invest, to take that risk, if it's an equity or something like a mutual fund or whatever, even debt instruments. And I know you're a specialist in fixed income instruments. Tell us, how does it work in terms of the suitability versus the appeal that one, and what are the parameters that one needs to look at? Over to you.
So Santosh, firstly, I'm humbled by the wonderful introduction.
Thank you.
So now, starting off for our viewers, so as you rightly said, what should be the right approach one should take towards investments? So like you said, sound of money. So money is very important. money is the lubricating oil which we need for our entire life.
Yeah.
And people should be careful about it. So the first and foremost and most important fundamental point I want to drive home is the approach people should take towards investment. And the first point is there is a difference between buying a consumption product and a financial investment product. So as an illustration, there's a difference between buying a car or a sari or a shirt or a flavor of ice cream and investing your life's hard-earned money. There is a basic fundamental difference. And what is that basic fundamental difference? You buy a car or a shirt or an ice cream. It is about, I like it. Whereas when you are investing your life's hard-earned money, it is not about, I like it. It is more like buying a medicine. It is not about whether you like it or not, whether you require it, whether it is suitable for you.
Yeah.
So like you said, the approach people take, asking friends or relatives or people around you, that, I mean, with due respect to people around you, that may not be the correct approach.
Yeah.
So it is like this, when you are buying a consumption product, like buying a brand of a mobile phone, it is okay to ask your friends, how is your experience with your brand of handset? However, when you are not well, do you ask your friends or do you go to a doctor? Because when you are not well, the medicine you take is fundamentally more important. And that is the approach you should take. So what is the approach you should take towards your investments? So for investments, there is something what we call asset classes. To put it simply, we have equity, we have debt or fixed income, we have gold, or if we have some other asset class to invest.
Yeah.
And ultimately, whatever investment products we have around us are a combination of these only.
Yeah.
And again, another fundamental difference between any consumption product and any financial investment product is that, you'll be surprised to hear this. In investments, if I may say so, there is no product. You're surprised, what is this? There is no product. Because there is no look and feel. Anything physical you are buying, like a car or a shirt, or a service you are availing of, like a haircut service, there is some look and feel.
Yeah.
Whereas in financial investments, there is no look and feel. And all financial investments boil down to only one thing. You spare your current consumption, you give your money to somebody only with the expectation that you will get back the money in future and you will get back a higher quantum. And whatever investment product you have around you, equity, debt, gold, or whatever you have around you, is a permutation of combination of how much higher return you will get, how or when you will get it back, and in that course, in that journey, like if you get it back after 1 year or 5 years or 10 years, how is the experience in that journey, the volatility in that journey? These are the fundamental aspects. So like I said earlier, appeal of investment products will be there. It is the job of the product manufacturer to make it appealing. If I were the CEO of a financial investment product manufacturer, I will do the same thing. I will say that my product is the best in the world. However, it is for you. No, like it is heard the term caveat emptor, buyer beware.
Yeah.
It is up to you to understand whether it is suitable for you or not, whether you require it or not. If you understand, like you say, DIY, good. If you do not, go to a professional.
Correct.
So it is important that you cut through the clutter, cut through the appeal and understand. To give a very simple illustration, somebody manufacturing and selling saccharin will say sugar is not good for health. I also will do. Yes, sugar is not good for health. But the point is saccharin good for health?
Yeah.
If you fall for that marketing gimmick, or marketing whatever you call it, sugar is not good for health. Yes, correct. Is saccharin good for you? If you can understand, good. If you don't, you go to a doctor or nutritionist.
Yeah.
So that is the basic fundamental approach people should take. And when I do my sessions on investment awareness, I throw a simple question to people. You are traveling in your own city and you don't have your own car. And you have an option of various public transport. You have the very simple auto rickshaw or public bus or something. Then you have those app cabs, Ola, Uber, or other app cabs. And again, there you have the various options like basic end, mid end, high end, sedan, and all those things. So for choosing what mode of transport you will select, not the answer, but what are the parameters you will look at. People quote 5-6 parameters: the cost, waiting time, comfort, safety, convenience, so many factors. And when I ask them, for your investments, what would you look at? People come up with firstly people come up with returns and maybe one or two others. And that precisely is my point. When you are spending 200 rupees, 500 rupees for something as small as a local journey, you come up with 5 parameters. When you are investing your life's hard-earned money, you come up with one or two parameters. So first of all, as we will discuss over the course of this discussion, that is the approach, fundamental approach people should take towards investing their hard-earned money.
Absolutely. So, Joydeep, the one thing that comes in mind is, right, again, it's the same thing. People look at returns, right? Risk is one element, but wo kitna dega is always the question in mind, right? Because that decides a lot of things. And traditionally, Indians have always been savers. And now, over the last few years, thanks to AMFI and the kind of awareness that's happened, the mutual fund Sahi Hai campaign, there is a transition. In fact, one of those very famous incidents, or rather stories that happened where one of the manufacturers of a top-notch car, the CEO said, guys, what's happening? Why are these guys going into mutual funds? It's impacting my sales. So the question is this kitna dega mindset that we have, and that's a reality. Let's accept it. Versus the risk. How do you able to kind of reconcile this?
Sure, that is very important. So first of all, this concept of kitna dega is of course important. And you would have seen that ad by the car manufacturer. Yeah. People asking kitna dega for a spaceship kind of ad.
Yeah.
So yes, it is important. The way I will put it is not to run down or belittle the concept of kitna dega, but kitna dega is only one of the criteria for your investment decision. Important, but not the only criteria. Again, to give an illustration, coming to food. So if I can equate your returns kitna dega and food, in food it is a taste.
Yeah.
In investments, kitna dega, and in food it is taste.
Yeah.
So which food you will eat, taste is of course important, but not the only criteria. As an example, nutrition.
Yeah.
Nutrition, calorie, all those medical stuff is there. Or other aspects like if you are a Jain person, that veg, non-veg kind of thing. Non-veg food, however tasty it is, a veg person will not eat.
Yeah.
So the point is, for food, taste is not the only criteria. Or for example, coming to your clothes. So how you would look in a particular cloth or how you would be perceived in a particular cloth is of course important. But again, not the only criteria.
Yeah.
As an example, if you look good in a t-shirt, if you go to some mountaineering, snow, you will not wear a t-shirt, you will wear a full jacket. So similarly, coming to investments, and you mentioned two very important things, kitna dega and risk. So kitna dega is of course important, but what are the other important criteria? So talking of the concept of risk, so there are multiple aspects to risk. Like if you open my textbooks, you will find some 10 aspects or facets of risk. To put it simply, the one most important aspect of risk is volatility. So volatility is how is your journey. As an example, if you invest today and you get back your money after 5 years or 10 years, over this 5 or 10 years, does it give you sleepless nights or is your journey smooth? So this volatility is one very important criteria. So there are certain investments which are very volatile and certain which are less volatile. And how would you know? So all these asset classes, equity, debt, gold, or any other asset class, they have a history. You can look at the long history, like 10 years, 20 years, 30 years, 40 years. What has been the return and what is the extent of volatility? Now, how to measure volatility? Again, there are so many complicated stats. I won't bore you with that. People say all these standard deviation, Sharpe ratio, blah, blah, all those things are there. To put it simply, there is a metric called drawdown. Drawdown means over a history of a product, from the peak return at a certain point of time, after that when the market falls or the returns from the asset class falls, what is the highest drawdown? As an example, if you look at equity, any Nifty or Sensex or any other metric you may look at. Look at the history of the last 10, 20, 30, 40 years. When the market falls, it is going like this, peak here, and it is falling. So from peak to trough, how much can it fall? As an example, historically, if you see equity falling 50% or whatever number it is, that means over the last 20, 30, 40 years, equity can at worst, at one point of time, give you minus 50% returns. I am not discouraging people from investments. People should invest. People should be aware that in the worst case scenario, equity or any other, be it debt or be it gold for that matter, in the worst case scenario, it can give you that much of negative returns. You should be prepared for it and then go for it.
Okay.
Now, people, our viewers would be thinking here, if anything is that risky, can give minus 50% returns, then why should I at all go for it? Why invest my hard-earned money? No. Like when you are not well, there are medicines. For investment risks, also there are answers, like equity. For equity, the simple answer to volatility is your holding period. History shows us you buy equity, invest in equity, you hold for an adequate horizon.
And what is
10
that
years.
adequate horizon?
Exactly.
Average.
So as a ballpark, it is 10 years. Longer the better. 10 years, 15 years, 20 years, the longer the better. History shows that, like the example I gave, it is here. You fall 50%. You just hold on. Over a period of time, it goes up again. And over a reasonable holding period, you end up getting decent returns. And what is decent return? As an example, 12% CAGR. CAGR is in compounded annualized growth rate. To put it simply, even after the fall, from your peak before the fall, if you get, let us say, 12% annualized return over, say, 10 or 12 years, it is a decent return. So your holding period should be appropriate. And to answer your question, what should be an adequate holding period? Like I said, 10 years is a ballpark.
Yeah.
It is not, it is coming from somewhere. There is a basis or reason for saying this.
Yeah.
There is a data published by NSE on Nifty and on a long history of Nifty. And they have done multiple permutation and combination on a daily rolling basis of Nifty 50 returns over a very long period of time. It shows that if your holding period is 1 year, you have a 25% chance of going home with negative returns.
Wow. Okay.
If you have a 2-year horizon, your negative probability is so much. With a 7-year horizon, at least as per history, you have never gone home with negative returns. Over a 10-year horizon, Nifty 50 long period of time, you have never gone home with negative returns. So that way, the ballpark is 10 years. You come, invest in equities, be prepared that equity can be volatile, and you come with an adequate 10-year kind of horizon. There are other aspects also, like for example, in debt, there is something called default risk. Basically, it means if the issuer of that paper, of that particular bond or debenture does not pay back your money. All those things are there, but volatility is the most important aspect of risk.
Absolutely. The other critical factor, and more so when it comes to retired class, working population who are non-finance kind of people, people who are probably NRIs may not be so much on the ground with the Indian realities, right? The concept of mis-selling or mis-buying is comes a lot into play. And especially, I know of so many of my own friends, returning to India on holidays or, just on a holiday kind of thing, have less time, in that span of time, visit a bank branch and in a jiffy sign on to products. So many retired people have no clue what it is. Again, the same FOMO factor, get on to risky investments. They have no idea what are they invested into. And you know what happens? The targets make all the difference on the other side. So mis-selling, let's accept, is a big issue in the industry. And I do know some of my own guests who've been on the podcast have been very aggressively advocating within these, the SEBIs and the IRDA and the other, regulatory, institutions to do something seriously about it. How much is mis-selling a reality today? And what's been your experience?
Yes, that is something very important for investors. Yes, and as you correctly said, mis-selling is an issue. So there are two ways of looking at it. One way is, as you hinted at, that, again, to put it bluntly, not to mince words, cursing the regulator. Yes, whatever is happening today, to a limited extent, regulators are responsible. You call it RBI, you call it SEBI, you call it IRDA, whichever regulator you call it. But, I would not go into that because, when you are in a particular situation, it is one thing to blame others. It is another thing for you to be prepared for it. As in, if you are facing a challenge, you can blame others that today I am facing this challenge because of the fault of yours, which may be correct, by the way. But the point is, when you are facing that challenge, instead of blaming others, faulting others, why don't you come up with a situation so that you save yourself from the challenges? That approach. So here comes the concept of buyer beware or misbuying. As you correctly said, retired people, and in particular the non-finance background retired people. And yes, it is a very unfortunate situation that banks, and as I say, targets. Banks do bulk of the mis-selling that happens. So people have been given targets, and banks, there is a bit of a turf war or turf confusion, so to say, because banks per se are regulated by RBI, and selling of financial investment products are regulated by SEBI. So it is kind of,
tricky how to whom to where to, and on whose shoulder you should keep your gun and shoot,
Yes.
right?
So it's like, stepson, stepmother kind of a thing, whose responsibility it is.
Yeah.
But you should be aware of the basics. Like I said, if you face a challenge, how you can gear up to the challenge. So my advice to senior citizens, retired people, non-finance background people is to ask the right questions and to ascertain whether that investment which is being pushed down your throat, whether it is correct for you or not, whether it is suitable for you or not, and only then go for it. And again, the priority is simple: risk. Risk is the parameter here. Like I said, equity. And as I said, for equities, I'm not de-recommending. It is about the investment horizon and having that appetite that whether you can withstand a sleepless night when equity is giving you minus 30% return. So what we say, for senior citizens, for retired people, your allocation to equity may be there, but not like 80%. It may be like 20% or thereabouts. Or for example, the most famous or the most rampant mis-selling, the ULIPs, unit-linked insurance products. That so-called linking of investments with investment insurance and blah blah and all those things. So all those issues are there. Basically, people have to ascertain whether this investment product is suitable for me or not. Coming to the previous discussion, instead of asking kitna dega, you should ask why it is suitable for me. And that is what people should ascertain. And again, it is not as easy. In fact, there was this thing run by in a famous newspaper, run by a famous columnist, a real life case, that an 80-year-old person, to quote your own example, went to a bank and he was being sold a ULIP product, equity oriented ULIP product. And his simple question and correct question was, would you sell this product if you were my son or daughter?
Yeah.
And they said yes. It is very unfortunate. They will not. But unfortunately, they said yes. So you have to be careful.
Yeah.
Ascertain. So how does a non-finance person understand this? To put it simply, equity is supposedly more volatile. Debt is supposedly less volatile.
Yeah.
So in the what we say decumulation stage means senior citizens, retired people, when you don't have active income and when you are living off your savings kitty.
Yeah.
You accumulated earlier and you are decumulating now. In the decumulation phase, you should have higher allocation to fixed income or debt because it is less volatile.
Yeah.
You may have like 60, 70, 80% in debt, some allocation to equity, like 10, 20, 30%, and some allocation to gold. And all products in the market are a permutation or combination of these things only. You call it mutual fund, PMS, AIF, or ULIPs, or whatever.
Yeah.
So these basics people should understand and then approach the investment.
In fact, the related concept that is coming out, and especially a lot of investors, because there's so much of now kind of awareness, some people feel, why not do it myself? This is a DIY concept. Having said that, the advisors also play a crucial role, especially if you don't have the time in the world, don't have the time to get the knowledge in the world on investments. So there's always this trade-off, between DIY versus advisors. DIY, I know you probably save on those commissions. At the same time, you get better NAVs vis-a-vis the advisors who are there to really help you out and channel your investments into the right product. So how is this kind of helping the investors? And one should really, maneuver through this maze.
Sure. So before I answer this, I'll just take 1 minute on the previous discussion.
Yeah.
While buying certain things, we are very particular. To give a very lay on the ground kind of example, when we are buying vegetables from the neighborhood vegetable vendor, we do so much of a thing. Like we take it in our hands, we do it like this and see it and do so much of things.
Yeah.
Whereas when we enter into a bank, we are so impressed by the board hanging outside. I won't name any brand, whatever that board hanging. Oh. So there also we should exercise a similar or actually higher kind of, our antenna should go up.
Yeah.
Why we are going for this investment. Yeah. Now coming to this thing, very important, DIY, do it yourself.
Yeah.
So DIY or advisor distributor, that's a debate. The debate has been there and the debate will be there.
Yeah.
But again, not to mince words, I will put my view here. My view is towards intermediary.
Yeah.
So my logic is, you must have, the viewers must have heard this saying, Sarthi zaruri hai.
Yeah.
Arjun, however good a warrior he was, he couldn't have won the war single-handedly without Krishna. तो सारथी जरूरी है. So again, to drive home the point with simple illustrations, when in my sessions I ask people, investor awareness sessions, which one do you prefer, doing it yourself or doing it through a paid professional intermediary? Most people prefer to do it yourself. Then I ask them one simple question. Tell me one thing. How many of you file your income tax returns yourself? Provided you are not a CA, how many of you go to a CA for filing your income tax returns, and how many of you do it yourself? So why is it that for filing your income tax returns, you have to go to a professional? Whatever we do, any medicine I have to buy, I go to a doctor. Any dispute, I go to a lawyer. I want to reach out to God, I go to a priest.
Yeah.
Why is it that when it comes to investments, now what you refer to now, savings, those commissions, and all that, that is correct. And you will see, if you do a Google, you will see those media coverages that you invest in a product and the differential in expenses, say, as an example, 1% per year. And you accumulate that, compound that over a period of 10 years, 20 years, it adds up to so much. And if you invest that, say, rupees 1 crore over a period of 10, 20 years, compounded effect, that 1% comes up to rupees so much, some big mind-boggling figure.
Yeah.
Those reports may be mathematically, not maybe they are mathematically correct.
Yeah.
But the point is, what is it you are doing? You are investing your life's hard-earned money.
Yeah.
So you have to be careful. It is worth paying that 1% or whatever percent professional fees to an advisor. Rather, you should ask the right question. What is the value you are bringing to the table in exchange for the fees I am paying you?
Yeah.
Instead of asking kitna dega.
Correct. That's
So that is the, yes, so that is the more important thing. And you know, this notion of DIY, I can do it myself, there's a reason for it. Example I'm quoting again and again, medicine, doctor. So again, to quote the same example, there's a perception that when I'm not well, I can go to the shop myself and at best buy crocin. I cannot buy complicated medicine. Because we have been fed with this view, yes, correct by the way, to our life. Whereas when it comes to financial investment, we have been fed with the view that I can do it myself. And how is it that we have been fed with that view? You open the TV, all those business channels. What are they shouting at you? We are covering everything that's happening in the market. We are showing you multi-baggers. We are showing whatever is happening in a company, whatever is happening in the stock. We are covering whatever is relevant, and you do this.
Yeah.
So you are given to believe that only by watching that TV channel, you can do it yourself. You open any newspaper, that's orange or pink or even white for that matter.
Yeah.
They are showing you multi-baggers. They are saying this is happening, that is happening. So it is being, you are being shouted at that read this paper, read this magazine, watch this TV channel, and you can do it yourself.
That's the
concept. Can you imagine a situation, as a heading, just hypothetically, can you imagine a situation, a TV channel or newspaper shouting at you throughout the day that if you are not well, take this medicine. If you are not well, take this medicine.
Yeah.
It doesn't happen.
Yeah.
So since you are being shouted at this thing, you are given to believe you can do it yourself. And there's one more reason to it. There is both a good and bad part of it. That is internet.
True.
Lot of good part
social
about
media.
Yeah, social media.
Telegram channels making a lot of difference.
I'll finish this part first and then come to Telegram.
Yeah.
So on this part now, social media, of course, it gives us so much of data, so much of information.
Yeah.
But also what happens is, since I can get data, people tend to get the false confidence, I understand it.
Yeah.
So I want to make one important point here. There's a difference between having the ability, let's say you're looking at a mutual fund scheme, which mutual fund scheme to invest at.
Yeah.
There is a difference between the ability, I can open my phone, I can Google, and I can find out the last 1 year, 5 year, 10-year returns given by this mutual fund scheme and actually understanding what that investment is.
Yeah.
People get this false sense of confidence that I can Google, I can find out the 1, 3, 5 year return from this investment. That is one thing. Knowing the market is a completely different thing, isn't it? So it is like this, if you have to do a surgery, you can also pick up that knife, but you can't do the surgery. Only a doctor can do it. You can pick up a weapon, but can you fight? No, only a soldier can.
Yeah.
But we think that since I can do that, Google. So it is like this for investments. Somebody who has actually spent 20 years in the market understands the market.
Yeah.
The ability of able to Google and find out the 3-year returns doesn't place you in the same footing as somebody who has actually spent 20 years in the market,
True.
which
Yeah.
is why I prefer the intermediary, even at the cost of the fees.
Correct.
Now coming to your this thing, this Telegram channels or various other channels and all those things. So again, there it is easy to blame the regulator, and I also blame the regulator to a very limited extent, because regulator can do only so much.
Correct.
It is my money. It is my hard-earned money. I should take the basic minimum caution before falling for something.
True.
So, of course, you have heard of it. Viewers also would have heard about the SEBI communication that 93% of individuals who play the derivatives market, equity, stocks, and futures and derivatives market, 93% of them lose their money. And even the few people who make profits, net of expenses like brokerage or other expenses, almost half of them make losses. So now, when SEBI is giving this communication, it is your choice whether you want to fall for that gimmick, for that appeal.
Yeah.
So it is like this. It is very easy to make a story and very easy to fall for that story.
Yeah.
You have to have your eyes and ears open.
True.
So I'll give another illustration here. It was run by a famous newspaper, and they actually gave the name and what was done by one particular so-called finfluencer. He ran a course, a 2-week course on equity derivatives. And what was the pitch? You do this 2-week course, and you can play the equity derivatives market yourself, and you can become a crorepati. Yeah. What was the fee for that course? 500 rupees. Wow, life is easy. Why do I work hard?
Yeah.
I just pay 500 rupees to that course of 2 weeks, and I play in the equity derivatives market and become a crorepati.
Yeah.
And in one financial year, how much that person earned? Rupees 63 crore from these courses, from the other things.
Yeah. Very appealing.
So, very appealing. Keep the price point low. People will fall for the selling a dream. People will fall for that. So that is what people have to be careful about.
Absolutely. So Joydeep, there are these choices of life when it comes to investing. Direct stocks kare, ya managed funds like your mutual funds, PMS kare. Actively pick equity pursue kare, ya leave it to passive investing. Debt may invest kare, ya equity may kare. These kind of thought processes that run, especially when you are talking to peers and everybody, as again the FOMO factor comes in. I know it's quite a interesting deep dive discussion, but on a very high level, what are your views? If you could share with your experiences, the guys that you met in the industry and otherwise.
Sure. So you know my view by now, since I prefer the intermediary. On the first part, buying stocks directly and going through a managed vehicle or managed fund. It could be mutual fund, it could be PMS, it could be AIF. I prefer the managed fund route. Of course, there's an expense. Whatever 1%, 2%, whatever expenses they are charging per year, those expenses are there.
Yeah.
Only if you know it, only if you have been in the market, only then you should do it yourself. So the criteria here is it that I think I can do it, or is it that I can actually do it? So it is like this now. To give you another illustration, in my childhood days, I thought that if I just pick up the gun, I can fight as good as a soldier.
Yeah.
Now I realize I cannot. So people have to use the same criteria, that just because it is easy for me to open a trading account with Zerodha or Grow, is it just that ability? Or is it that I actually have 20 years hardcore experience in the market? Yes, if you have 20 years hardcore experience in the market, yes, you save your brokerage, you go for Zerodha and Grow.
Yeah.
But otherwise, is it only that sense of confidence? If it is only that sense of confidence, no. Then you go for a managed vehicle. Why? In a managed vehicle, the fund manager, be it a mutual fund, be it a PMS, or be it an AIF, the fund manager gets salary in crores. Why? Simply because he or she has reached that level. He or she has proved that it is I'm worth it.
Yeah.
Only then someone is paying him or her salary in crores. So there's a reason.
Yeah.
So if it is only a false sense of confidence, no, then go for a managed vehicle. That is the first thing you asked. The second thing you asked was which one? Was it active passive?
Active passive, yeah.
Yeah. So active passive is again very interesting. So it's a very heated debate in the industry, and if you go through social media, you will find two camps. One camp fighting for active, and one camp fighting for passive. I will not go for that debate. I will put it in a different way. It is not active versus passive. It is active and passive. Both. Both have a place in your portfolio. Again, to clarify for the benefit of viewers, because we have a wide cross section of viewers, what is active, what is passive? Active is a fund where the fund manager takes active calls in stock selection. So he or she will say, "ये stock मुझे अच्छा लगता है." What to buy, when to sell, how much to sell. All these fund management decisions are taken by the fund manager. And the passive fund is where the fund manager does not take any active decision. He or she only mimics the underlying portfolio. It could be Nifty, it could be Sensex, it could be any portfolio. So whatever stocks are there in the underlying portfolio, you buy the same stocks in your fund in the same ratio. That is passive fund management. So what is the genesis of fund management? So somewhere down the line, sometime earlier, there was a gentleman called John Bogle in USA. So he started this concept that to my fund manager, I am paying a fee, like 2% or whatever percentage I am paying a fee. In exchange for that fee, I expect my fund manager to generate the alpha. Alpha as in, if the underlying index, like in the USA talk of Dow Jones or whatever, Nasdaq or whichever, S&P, whichever index talk about, I should get a return higher than S&P or Dow Jones or Nasdaq. If I'm not getting that, why should I pay the 2% fees to my fund manager? I will simply buy the index. Now, to buy the index, it is not impossible but difficult if you're a layman. So then he floated products. He said, I will charge you a very low expense ratio, and I will simply mimic the index, buy the same stocks in the same ratio, same proportion. No rocket science. And I have no pretense of outperforming or pretending to outperform the benchmark. So that is where Vanguard started, and today Vanguard is the leader. And today globally, if you look at active fund AUM and passive fund AUM, or particularly in the US, it is somewhere equal.
Okay, that's interesting.
So in India also the trend has taken place. Both active and passive are growing. But today in India, at least in the mutual fund space, it is more of active. To give you some idea, today in the mutual fund AUM, approximately only 17% is in passive. Passive AUM is growing, but since active also is growing,
parallelly,
that 17% is kind of okay. Now to answer the basic question, active or passive, like I said, it is not active versus but active and passive. The way I would put it is, if you're investing in say some large cap stocks, large cap now for the benefit of viewers, as per service definition, the top 100 caps as per market cap. In a large cap space, the fund manager can do only so much. So for large cap, you go for a passive fund management, a fund that mimics some Nifty 100 or whichever index you think fit. Whereas where there is a scope or space for the fund manager to show his or her skill set, it could be a sector fund, it could be a theme fund, it could be a small cap fund or whatever. For those investment ideas where there is scope for the fund manager, for that you go for an active fund. So that's about active and passive. What's the other thing you said?
No, so essentially I wanted a kind of a comparative. I think you've taken care of most of these aspects. I also want to talk to you, Joydeep, on these themes of the moment with a lot of television channels, a lot of media does talk, especially the financial media. Equity, gold to hai hi, mutual funds to hai hi. But then comes the crypto, which is the elephant in the room, and everyone wants to be, and that's where FOMO plays a crucial role. So talking about crypto, to a large extent, everyone says try to karte hai, but we all know it's sometimes a deadlier monster than even a derivatives, because isme to kuch bhi pata nahi hai, right? And people want to get into it because it's the FOMO end of the day. What are these themes at the moment that are currently working in Indian markets?
Sure. So to quote my earlier illustration, there's a difference between buying an ice cream and investing on life's hard-earned savings. It's one thing, you go to a restaurant, you see the flavor of the day or a flavor of the week. The flavor can be good. I'm not belittling that. But there's a difference between buying this and buying an investment product. So like you said, a cryptocurrency. So, okay, you like this view, don't like this view, viewers like this view or don't like this view. I as an individual will say no to cryptocurrency. And to make it clear, yes, it can give you high returns. You never know. If you look at those charts, there are those year-wise, what's called quilt, investment quilt, like, year so and so, what has given the highest return, like crypto or Nasdaq or Nifty or gold or whatever. So many of those years, Bitcoin has beaten others hands down. So crypto can give a good returns, but still why I'm saying don't, because it is the risk level.
Yeah.
So either you don't, or maybe 5 or 10% of your portfolio, which you can put it simply, which you can afford to lose,
Yeah.
only that much you should put in crypto. It is like this, for that 5 or 10%, if you get good returns, you are happy. Even if you lose the principal, you don't mind, that kind of thing.
True.
So at any point of time, there is a flavor of the time. Don't fall for it. So why crypto? Why not crypto? As in, to tell you my view, first of all, what is cryptocurrency? First of all, whether it is a currency or not is a question. Because what is currency? It is the legal tender.
Yeah.
Whatever the government of the country says, be it US dollar or be it Indian rupees. Crypto as a currency does not have approval of any country, any government in the world. Only one small country. There's a country called El Salvador.
Yeah.
In there it is official listing. Otherwise, no reasonable country in the world has crypto as official listing. That is point number one. Whether it's a currency or not, it's a question.
Yeah.
People say acceptance will increase. Yes, acceptance will increase. Today, Starbucks says, I'll give you coffee for crypto. Today, Tesla says, I'll give you car for crypto. Good. Tomorrow, somebody else will say, I'll give you my product for crypto. Yes, acceptance will increase. But think of it simply. If I tell you, I give you 100 rupees, you give me 110 rupees. How does that sound? Tell me. I give you 100 rupees, instantly you give me back 110 rupees.
Yeah.
How does that sound?
Yeah, there's something unusual about it. Yeah.
Now, if I tell you, I will give you 1, you give me 1 lakh. How does it sound?
Totally out of
So if
context.
the price of 1 Bitcoin is 1 lakh USD, think of it.
Yeah.
You are giving 1 lakh real USD for something called Bitcoin.
Yeah.
Why? Because someone somewhere believes that beyond a point, cryptocurrency cannot be mined.
Yeah.
And when that limit is reached, there will be so much of demand and there will not be any fresh supply. So the price or will.
Yeah.
Simple thing. That understanding, who has signed the agreement, who has seen the agreement.
Yeah.
If mining happens beyond that date, who will take whom to
Correct.
court of law?
Yeah.
So Bitcoin, we all know that fictional character
Yeah.
who supposedly started Bitcoin. No one has ever seen him or her. It's all fictional.
True.
So that is, I think, it is very high risk. So don't fall for the. There's a difference between crypto and gold. Today, whatever is happening geopolitically, some people prefer to move away from the formal system to the informal system.
Yeah.
Be it US, be it any other country in the world, certain things are happening. Geopolitical risks are high. But gold has a history. It has thousands of years of history.
Yeah.
There's a touch and feel.
Correct.
Central banks have part of the reserves in gold. Whereas crypto is like just a concept, which is why I'm saying no to crypto. So for your investment, to summarize this part, only a small part, maybe 5-10% of your portfolio, you fall for that theme of the moment, which you can afford to lose. You may get good returns, and then stick to the fundamentals, because again, at the cost of repetition, it's your hard-earned money.
Absolutely. You touched the geopolitical scenario, and I think today's world investments, whether domestic, whether international, and even if domestic in mutual funds and equity, geopolitics is playing a very, very crucial role. And we saw that not geopolitics, but even something as crazy as COVID, right? The markets tanked and they went up on a different level. So these are factors probably which are beyond mine and your control. Having said that, one needs to be cautious. One needs to be at least aware of it. So how do you manage or plan your investments, keeping in mind these geopolitical events, which are very many in nature today? I mean, this has become a subject space now, because you have conflicts almost in 3 to 4 regions of the world. You have a lot of the deep state, as we have been talking about. You have a lot of business controlling politics, and the other way around too. Yeah. So one needs to be aware, and these are completely television news and social media that feeds in the content in you, right? But having said that, one needs to be mindful. What's your stake? What's the industry view on this? View on geopolitics?
Sure. So on geopolitics, for quite some time, there is one big change happening. So as we record this, today the top of the mind, what is called recency bias, is the India-Pakistan thing.
Correct.
But again, look at the big picture. What I refer to as a big geopolitical shift happening, that is, if you look at the last, say, 30, 40, 50, 60 years, we had one big daddy, that is USA, and we had one reserve currency. Even today, USA is the big daddy and US dollar is the reserve currency. However, that is where the big change is already happening, already taking place. So if you do a Google and if you look at the life history of the reserve currency at a given point of time, and if you look at the last 700 years of history, each reserve currency, country or currency, had a certain shelf life. Today, that shelf life of US dollar is already over. Today, US dollar remains the reserve currency because of TINA factor. There is no alternative. And they will remain the reserve currency for some more time, 10, 20, 30, 40 years. But their downfall has already started. Why I'm saying this? If you look at the fundamentals of the reserve currency or the reserve country throughout history, whenever that country was the reserve currency of the world, there was an implied understanding, implied assumption. That is, that country will be strong. That country will give military protection to someone when required. If someone asks for military protection, they will give the protection. And that country will share their GDP with others. When I say share GDP, I don't mean charity. It means trade. Today, you look at it, what USA is doing. Okay, they are the big daddy. But today, the POTUS, the president, he's saying other countries should not outsource their defense budget to us. From his perspective, he's correct. But look at what's happening. Today, he is anti-trade. If you look at what's happening or what the US is doing today, that so-called America first, it sounds good. But basically what it means is he is moving away from global trade. He's anti-global trade. So he is not sharing US GDP with others. When he says that other countries should not outsource their defense budget to us, in a way he is correct from his point of view. But basically he is saying is, I will not give military protection to others when required, when they ask for it. And if you look at it, the reserves of central banks in various parts of the world, today they are moving away from US treasuries to other things like gold. So what is happening globally is, if US is gradually moving away from being the big daddy and less of interference into other countries, which is in a way good, but it also means geopolitical tensions will increase.
That's the reality.
Be it Russia-Ukraine, be it Israel-Hamas, be it China-Taiwan, be it India-Pakistan.
So Joydeep, before I let you go, one last point I need to cover, it's very essential, is about the data, sources of data, and more importantly, how to track the data. So how does one really reconcile that? And again, I'm talking about connecting the dots, and more importantly, the impact it has on the portfolio. If you could share your views on that.
Sure. I will just take 1 minute to make one more point about the previous discussion. On the geopolitical thing, your basic question was impact on your portfolio. Now, since I said that geopolitical tensions will increase, so the risk, to put it simply, is if whatever is happening blows out into a full-blown war. As of now, hopefully, chances are less. But what will happen if it becomes a full-blown war between whichever country? Equity market will tank. But the silver lining on the cloud is that today, India, we are actually in a better position. So Indian equity, while impact will be there, it will not be as impacted as some other country. Whatever trade, tariff, tension, whatever is there, India will be impacted, but will be impacted less than many other countries.
Is it because we are decoupled internationally?
So again, that will take some time. That's a big debate. So it is like this: when we say decoupling, people debate and debate and debate. First thing is, what is it your debate? Decoupling of what? There are three aspects of it: decoupling of economy, decoupling of trade, decoupling of market movement. So all different things. So to put it briefly, in certain areas it is decoupled, certain areas it is not decoupled. Why I say India will be impacted less on international trade? We have a large domestic economy. Our dependence on international trade is much lower than many other countries who are more dependent. Hong Kong, Singapore, Philippines, Malaysia, Vietnam, they are more dependent on the external sector. We are less dependent. So we will be impacted less. So net, come to equities, Indian equities mostly 80-90% of your portfolio. Come to Indian fixed income, gold to an extent, 10-15% of your portfolio. Be it keep it an India-oriented portfolio, maybe a little bit of 10-20% investments abroad. Have a long investment horizon, and risks will kind of take care of itself over a long period of time. Now coming to your question of sources of data.
Yeah.
So as I said, today internet, there are both good and bad parts to it.
Hmm.
So in terms of data, it is mostly good.
Hmm.
So there is some propaganda also by whatever some people.
Yeah.
The good part is it gives you lots of data. So today we actually have a plethora of data, oversupply of data. So what should you do?
Hmm.
You have to have your filter.
Hmm.
So many stuff hitting you.
Hmm.
So many people giving so much of views. Cut through the noise, cut through the clutter. What is actually important for you? Apart from the views or the noise, what is important? As an example, the GDP growth rate of the country. What impacts the GDP growth rate of the country positively? What impacts it negatively?
Yeah.
What is the inflation? What is happening on the external sector? Current account deficit, dollar rupee exchange rate. These are the basic things you should follow. And whatever you see on the headline, newspaper, media, social media, whatever you see on the headline, think of it. What is the impact of this on these basic parameters? GDP growth, inflation, exchange rate, and all those things.
Yeah.
Forget the politics and those things. So whatever you come across, because the mind space here is limited, unless you are an investment professional, you are doing whatever you do, your time is limited. So through the filter, this you can afford to ignore, this you should actually track. Even what you are actually tracking, importance wise, ABCD.
Yeah.
And look at it this way, that what is the impact of that on your portfolio of investments? And again, if you are doing it through an intermediary, if you are investing in managed funds, mutual fund, PMS, AIF, there's a professional taking care of it.
Yeah.
And on top of that, if you are going through an intermediary, you're paying fees to the intermediary also. How this helps you is in asking the right questions. So and so is happening in the world today. What is the impact of that on my portfolio? How should it behave? And for the DIY investors, as I said, something or the other will keep on happening every day.
Yeah.
Today it is India, Pakistan, tomorrow it will be something else. Just be clear of your vision. It's like this: if you are on a journey going from point A to point B, you don't get down midway because something is happening at the platform. You complete it, unless it is a very serious like fire or something, you don't get off. So be clear of your objectives. I want to go from point A to point B. Be clear of the risks. Volatility, defaults can be there on the way. Know the risk beforehand. Knowing the risk fully well, you embark on the journey and stay the course.
Absolutely. Joydeep Sen, corporate trainer, author, and columnist. And more importantly, his name has such a lot of meaning. He brings in joy, and the deep, he always guides you in the right direction. That's Joydeep Sen for you and
Thank
me,
you.
guys. Thank you so much, Joydeep, for being on this podcast, The Sound of Money. Hope you enjoyed it.
Thank you so much, Santosh.
And well, with that, we'll come to the end of this very special episode of The Sound of Money from me, Santosh Sirur, and my guest, Joydeep Sen. Thank you for being on this podcast. Bye-bye and take care.
The Sound of Money with Santosh Sirur.